Michael, welcome.
Thanks for having me.
I feel bad because this was such an out of consensus view a couple weeks ago. And I feel like by the time we're having this discussion today, don't you think it's almost become more of people don't think you're as crazy as they once did, I bet.
Well, we'll see about that. Certainly, the market has been making a V pattern upward, and there's been a tremendous amount of skepticism about that. But we're just starting now to see some evidence in the data turning. Obviously, you've been reporting on some better than expected housing numbers, but we're seeing it in other places too. As reopenings get underway in virtually all states now, we're starting to see activity bounce off of very low levels.
Yeah, and there's something I think fundamentally that you use to explain all this that people really need to know about, which is if you look at this from the monetarist point of view and compare it with what happened in '08, back then all of the Fed's efforts didn't really get M2 or other money supply measures growing much. This time around, they are having more traction. To you, does that say not only is a V-shaped recovery possible, but I'm curious what you would say this tells us about what it might look like after that. Are we still going to have a weak economy for the next 2 years?
Well, I sure hope not. It does appear that the Fed is getting more traction this time than at least in the opening innings of the crisis response during 2008. So if you remember the back half of '08, the Fed's balance sheet went up by 2.5-fold, yet broad money measures were barely moving forward, 4 or 5% growth. This year, the Fed's balance sheet's up about 70%, but these broad liquidity measures are up about 20%. So this is much more bang for the buck than what we saw last time. Now, the velocity of money is still depressed. That's the story of low market interest rates. We have a sudden and dramatic collapse in the economy that's taken shape, but the recovery off of this collapse should be much more vigorous than the recoveries after the last 3 recessions. And I think that's what a lot of commentators seem to be keying off, is the slow recoveries after the last several downturns. Probably not a good model for the upswing that's in front of us.
Final question. How do the models kind of incorporate the idea that there's going to be a ton of debt on the corporate side to get through coronavirus, and that repaying that debt means they're not investing, they're not growing profits the way that they once were, that itself slows down the recovery in the future?
Yeah, I think that would be a bigger risk if the policy response weren't so aggressive. And, the nature of this shock is different as well. The shock was not the result of corporate debt levels being high. The shock was a result of a pandemic and shutdowns as a way to deal with the pandemic. And so I think the debt levels are a concern, but they will not prevent this economy from starting to revive. This is probably going to go down as the shortest recession in U.S. history, also the sharpest. So I'm not trying to downplay it, but the peak to trough downturn is probably going to end up totaling 4 or 5 months, shortest in history.